About 25 after 12. It's Thursday afternoon, and we're here for another edition of Chart the Markets with our friends from FEG Token and SmartDefi.com, and a special thanks to BYDFi Exchange for awarding our trading bonuses to lucky users of their exchange every week. We're a little bit behind schedule today, so I'm going to get right into what I want to talk about. Recently, very recently, started working with someone who is brand spanking new to trading and charting, and is very eager to learn how to read price on a chart. And I commend anyone who wants to invest the time in themselves to do that. But in the process of starting out with them, I realized, wow, it's been a long time since I had to think of the market in the context of someone brand new. And I had this overwhelming feeling that they would be overwhelmed as well. And what I want to do today is talk about or show you how, with minimal tools, we can effectively trade the market in any time frame and any asset. And one of the biggest challenges that a lot of new traders have, or many of us, is that I love TradingView. I think it's one of the best platforms, if not the best platform out there, along with maybe one other that it's a strong second for me. But not everybody has the ability to have a subscription that has the ability to put on a dozen or 20 indicators or whatever it is. If you're new and you're just starting out, you sign up for a free TradingView account. I think you have 2 indicators now, right? So that makes it a little challenging for the new trader to decorate the chart with what they need. Right now, there are some workarounds to those things, and the community scripts within your indicator section will hold a lot of those answers, because in there you will find maybe a script that has a couple things within it that will get you through, like maybe it has a MACD and an RSI or a stochastic or something to that effect, and some other things, depending on how people trade, will depend on what they create. But what I want to show you is, what you see is, this is a chart for ETH. This is a daily Ethereum chart. All that's on this chart right now is a 5 EMA and a T line. Now, and this is not the Blunthouse script. This is just a 5 EMA and a T line. They're just the same color as we always use. So we're not going to get any signals, right, from this chart. But what we want to be able to do, especially for a new trader, is I don't need to teach you candlesticks right out of the gate, right? There is a gentleman by the name of Stephen Bigelow. There should be some videos of his still on YouTube. I believe he's passed, but I believe his videos are still there. And if you want to learn how to read candlesticks, spend a little time watching Stephen Bigelow's work, because he will be a tremendous help, right? And that's where I learned a lot of my candlestick reading, was from him. But ultimately, when you're brand new, I feel one of the most important things for you to be able to do is to sense the ebb and flow of the market. And if you've ever seen a professional race car driver, either an IndyCar or a NASCAR driver, before their race, you'll see them in the cockpit with their eyes closed, and they're flowing back and forth, almost like they're rocking, but they're literally driving the track in their mind, right? And there's an ebb and flow to that track. There's an ebb and flow to your chart. And anyone who's been trading and charting long enough knows that when you get in that zone, there's nothing that can break you. That concentration, kind of being at one with your chart or the car, there's nothing that can break that. But it's something that doesn't always come naturally, right? You have to experience that ebb and flow yourselves. And charts, as we talk about all the time, when you see how price moves up and down, because nothing moves straight up or down, it can get really difficult and choppy and sometimes hard to read. And what I like to do is I will like to take the noise out of the chart. And one of the simplest ways you can take noise off this chart that has only essentially two indicators on it is to change your candlesticks to Heikin-Ashi candlesticks. And Heikin-Ashi candlesticks are fantastic for trend, right? You know, you almost have that visual sense of the ebb and flow that the market makes as you look at this chart with the Heikin-Ashi candles on. Are they a little bit different to read than your typical price candles? Yes. But they're very helpful in taking the noise off the chart that sometimes overwhelms us. Any trader, right? It's, you know, regardless of your experience, sometimes it's just the nonsense gets in your scale of view and you just can't get rid of it. This is a great way to take a lot of the noise off the chart. But again, we don't necessarily have our script running here. You know, we only have a couple indicators. What can we do to give us a trigger? Well, we can use our T-line in the 5 EMA to a sense. There's no stochastic RSI parameters running in the background to filter signals out, or false ones anyways, or anything like that. But, you know, we could simply see that when we have a cross of the 5 through the T-line on the way up, that we typically have a bullish move. We didn't get a cross on the way down, the trend held and it continued. So we can use that as a simple measure, but we do have another thing that we can use. And if you've ever heard of parabolic SARs, which stand for stop and reverse, this is what they look like. Those little dots that you often see on someone's chart. Now we have a trigger and confirmation. So what am I talking about? Well, here you are. Let's look to the bottom left of this chart, and we can see our 5 EMA and T lines start to arc up. And that happens, remember these are Heikin-Ashi candles. We can see that we no longer have parabolic support. We're starting to get, bodies are starting to get shallow, which on Heikin-Ashis kind of tell you that they're losing a little bit of momentum. Right, so we can see that we're in a downtrend, and we can also see visually that maybe we're starting to arc up. But when do you take your trade? Well, we have a couple options. If you're going to use this Heikin-Ashi methodology, which I highly recommend for anybody to use, it's very, very simple. What you're looking for an entry candle is a solid green candle, which this one is. All right? But you're looking for one with no lower wick, which this one has, but you're looking for a parabolic beneath price, which this one does not have. So this does not qualify as a true entry candle, but this one does, right? You're looking for the parabolic beneath the green candle with no lower wick. That would be your entry candle. Secondarily, if we actually go back to this candle, you do have, I believe, your cross came on the next candle. So you basically have confirmation just before you got your parabolic. So all you're doing is adding parabolic SARs and using 2 moving averages, and you can have an entry and a trigger and a confirmation. Whether you consider the T line or the 5 crossing up through the T line as your entry and the parabolic under price as your confirmation, or vice versa, it doesn't matter to me. What I'm trying to show you is that if you are limited on the number of indicators you can put on your chart, there are workarounds that you can use, and you're not giving up anything. I have friends on this platform that use Heikin-Ashi candles on a regular basis, and I think they're absolutely fantastic traders and have tons of respect for them. And one of the reasons they like them is because A, they like to trade trends, and they would probably say, why would I like to make things more difficult for myself than they need to be? This is a 4-hour ETH chart. So again, which would our entry candle be on this chart, on this run up to the left? It would be the first solid green candle with no lower wick and a parabolic beneath price. So this would be your entry candle. And what is this? This is a 4-hour ETH chart. And just like the regular candles, I just note how price rides up the 5 EMA and the T line. We're not doing anything different using these candles than we are on our other charts. Right? Price is behaving the same way. Right? So parabolic beneath price, beneath that green candle, no lower wick, that's an entry candle. And then you also have, in and around the same time, that other cross, the 5 coming up through the T line. So you have two real quick and easy signals and confirmations to work off of. Right? Now, how do you know when to exit the trade, right? Or to go short? Nothing changes in how we read the T line and the 5 EMA, right? We're looking for one to cross down through the other to kind of confirm for us that the trend is definitely on the way down, right? On our regular script, we would probably be showing a red here as opposed to white because there'd be enough momentum down to trigger us or to trigger that. But nevertheless, you can sense just because your parabolics have flipped, right? They rode you up here, but now they're riding above price. So when the parabolics flip, that's a signal that you're probably topped out, and you also have to note the wicks on these candles too, right? That's price being pushed down at a top. So all these little cues that you can take just off these, a different candlestick, 2 EMAs, and parabolic SARs. And this is a very, very, very consistent way to trade and safe way to trade. And nothing changes in how you determine the short, right? So your entry, this is a 4-hour ETH, is in this case the first red candle with no upper wick and parabolic above price. So this candle here doesn't qualify because there's a wick and then there's a parabolic above it, but this one does. No upper wick, parabolic above price. That would be your entry candle short. And then you find price or the candles basically behave no differently than anything else. You stay on the south side of the T line and the 5 EMA, which tells you, the T line and the 5 EMA are telling you what the trend is, right? That's consistent. That does not change. Even if we were using no candles and just a line, does not change. We can even show you a line. There's where it changes, right in here. So is this consolidated flat trading that would probably feel like a few days of dead money? Absolutely. You probably would have taken it off somewhere when it looked like it might be closing a bit of that gap. And that's totally reasonable. That would have been a great trade. But this is, again, a very simple way to determine an entry and an exit of a long and short trade with minimal risk. Where does it get hairy for everybody? Well, I'll tell you where. On the lower time frames, right? Because I know a lot of you are trading them. And it's the big moves in price that can cause you a lot of angst. Right? However, if you have the patience, these are actually, if you're day trading as an example, or you're trading short time frames, this is a real nice trade, right? Even this, so's this. changing the candles gives you a better sense of
Sorry.
trend, and the T line and the 5 EMA will guide you through the trade just like they always do. Right? And again, you're only
I have a quick.
using two EMAs and a parabolics. Yeah, yeah, Mike.
Yeah, sorry, Blunt. Didn't mean to cut you off there. So, because I use SMA, so simple moving average.
Hmm.
So, and you're using the exponential moving average. What's the difference between both?
So exponentials will have a look back when they're calculated.
Right.
Okay, now all the other moving averages that I use on my chart are simples. All right, with the exception of these two. So on on my charts that you see, this yellow line and this white line is the T line is yellow and the white is the 5. And I use them as a filter of trend, right? Because you can see how price likes to respect levels, and I'll show you another example from yesterday and today of how I would use this methodology myself, right? But how you manage the T line and the 5 EMA doesn't change, right? It's your filter and your trigger, right? It's filtering your trend, and it tells you when it's probably changing. The simple moving averages I like because they're just pure, right? I always typically will have a set of EMAs and SMAs that I can deploy at any time. So I'm not saying that I don't use EMAs for other setups. I do. If I don't feel I'm getting a good read with my simple moving averages, I'm going to switch them to something that does give me a read where I can feel comfortable. The EMAs have a look back, no differently actually than the Heikin-Ashi candle that has a look back in it when it's calculated than when it calculates the next one. And that's basically there as a smoothing mechanism, really, as well. So um, I just like using
Okay.
the T line and the 5 EMA as the filter and the trigger, and then the SMAs create the fractal ranges for me. Right? Now we're only looking at two averages right now, but quite often you'll see when I deploy them all, it looks like a rainbow, right? But those are my ranges and targets for price. Price will move in and out of those ranges, just like we show all the time. But that's really
Cool.
the only difference.
Okay. No,
But
I get it. I get it. Because I didn't know if there was a major difference between the simple and exponential. Because I've just thrown in. Um, because obviously, you know me, I use my uh, 2150 and 200 uh, simple moving average, and then I just put in the 5 exponential moving average just to see the sort of difference, and they quite sort of go hand in hand. But yeah, just wanted to know like if there was a major difference between them two.
I would say that the T
Oh,
the T line and the 5 EMA are probably more well tested than using something as an alternative. 1310 is also quite common, but 5 and 8, that's what I prefer. That's what I teach people to use, and we have pretty good success with it. So, what we're simply trying to show is that for those people that are restricted or feel restricted because they can't deploy all the indicators they would like to deploy, I want you to know all is not lost. Okay, there are some workarounds. Get into those community scripts and dig around. There's a lot of people that have done a lot of good work in there, and I'm sure you'll find something that will give you everything that you need. The script that I wrote gives you 9 EMAs. Well, it actually gives you 9 moving averages that you can set. I say they're EMAs, SMAs, volume weighted, Hull, and so on and so on. A volume profile, and of course, all the EMA setups that you would need. Now, I'm just going to add a volume profile because I know that we were talking about it, and I'll just add it really quick. So, what does the volume profile do? So, there are simple ways for you to set up your chart so that you can take advantage of these these trend moves even when you're new. You just have to do what you're told and understand what the rules are. So what are the rules? If you're going long, you're looking for your green candle with no lower wick and a parabolic beneath it. If you're going short, you're looking for a parabolic above the red candle with no wick at the top. When price trades up and down these levels, that's how you know you're in a trend move, and you're using the 5 EMA as a trigger with your T line that filters that trend. This is a pretty good example of what that looks like. Okay, and it's not all that hard to do. Okay, let's look at.
That's another question, Blonde.
Yep.
Sorry, man. Because I'm always hearing you say the word parabolic, and I think I thought I had it in my head what it meant, but could you just again, might be some people who are new to it. What exactly does parabolic mean?
So the parabolic SAR, the SAR means stop in reverse. So these would be potential stop loss levels for traders. That's kind of what they are. That is what they are. What we're using them for is more of a confirmation that we're on the right side of the trade. I'm not necessarily worrying about it as a stop loss, because if I would have taken this short, Mike, like if I would have taken this short, my stop loss would be somewhere up here. Let's say I got in at this candle or this candle, my stop loss is going to be somewhere up here, and then when I'm comfortable that I'm in the driver's seat, I might start dragging it down to lock in my profits, as an example, or be using a trailer, right? And I'm going to talk about that in a second, but that's all they are, right? We're just using it as the confirmation as an entry candle. I wouldn't have my stop up here, right? Especially if you're leveraged, you're going to have to be tighter.
Okay.
Right?
So the yellow dots that we're seeing, that's the parabolics.
That's correct. Stop and reverse levels, that's what they are.
Is that an indicator, or is that just... Yep. Oh, okay. Oh, okay, cool.
You'll find it in your list. Right? So what we have here on this 30-minute chart, and I'm always switching time frames. You hear me talk about multiple time frames because everything is fractal, right? We live in a fractal world, and what do I mean by that? Well, what we see in one time frame, we'll see in another. If I want to know what's inside, let's say I'm looking at a monthly candle and I want to see what's inside the next one, well, I click on the monthly chart. And then I want to open up that, I click on the daily chart. It's like a nesting doll. You open up one and there's another inside. We'll think of that as the time frame, because everything is fractal. And what you're going to see here on the 30-minute chart for ETH is this big volume gap. I will look for these volume gaps, right? Whether or not price falls into this gap and falls all the way down, that ultimately would be my wish if I was short. But there's a lot that's going to go on, in between here and here on a 30-minute chart. But I look for these big gaps. I look for these shelves. What is this shelf going to provide? It's going to provide support and resistance, and the shelf along the point of control, which is this red line, is kind of like your equator, right? It's the area that's averaging off all of this past price, right? And that's the point of control ends up being up there in this case. Upper value range. Now I want you to notice how price bumped its head as resistance on the upper value range. So if you were trading this, blow this up a little bit. So if you're trading this, you know that you're in an uptrend, right? Or the divergence that you see between the 5 EMA and the T line is telling you that you're in an uptrend. Even on this pullback, you notice how price held the T line and the divergence held, because this is what you would be looking at, right? That divergence has held right at support, and then your next candle is green, and so on and so on. Now you're back to this upper value range where you found resistance in the past, right? These two candles that wick it and fail, that probably has your attention, right? And you'll notice that you went from having parabolics below price to now there's parabolics above price. And it's just, think of it as the market's way of telling you that, hey, I might be shifting sentiment a little bit. And lo and behold, what do we have? You actually got a short candle here too. So this was a false signal. If you were following the Heiken Ashis, you would not have taken this signal because you'd be using our methodology of what the T line does as a filter and the 5 EMA does. This divergence was telling you, although that was an entry candle, this divergence was telling you to stay in the trade. Okay? So your T line and 5 EMA actually filtered out a false Heiken Ashi signal. There's your resistance. And now here, you can see the arcing that's taking place right between the shorter time frame averages, the 5 and the 8. Now you've got a parabolic above a red candle with no upper wick, and you can see the divergence between the 5 EMA and the T line, which is telling you your trend is changing. And there you go. Right, look at that divergence. And you're following this until the chart tells you that this move is over, and it hasn't told us that yet. Do you see how powerful this is? Oh, you can't tell where price is going just by two little lines. Yeah, you want to bet? You want to bet? Sure you can. Can we simplify it even further to help you determine when you can get in safely? Yeah, we can. Of course we can. And this is, anybody can do this. A new trader can do this, right? That's what's great about it. Now, I want to show you one chart. Somebody might have a mic on.
Just very quickly, Blonde, as well.
Yep.
When you say T line, is that another indicator on
Nope.
TradingView I can go? Is that part of like the script?
The T line is the 8 EMA.
Oh, okay, cool.
That's all it is. It's just called the T line.
I'm with you.
Okay.
These are all questions I should have been asking at the very beginning instead of acting like I know.
No. So I'm just going to switch back for 1 second. I'm just going to switch back to regular candlesticks because I want to walk you through this kind of stuff that we talk about in real time in a situation that I've traded through. Okay. So this is the 30-minute chart for ETHFi, which is one of the alts that I happen to trade on a regular basis. For some reason, we like each other. And I'm superstitious, so I continue to trade it nevertheless. If you want to follow this a little bit, there was a post yesterday on X for this very trade. Here's an entry right here. Just want to blow this up a little bit. So that was my entry at 95.84, and the entry was short, and it was a leverage trade. Okay, that trade on this time frame, which is kind of the time frame that I was working off of, down here you'll notice that, which is the 12-hour. Here's this would be where the 200 MA is roughly, I believe, if I did this right. Yeah. Okay, so this was my 200 MA. I knew this level was the 200 MA on the 12-hour because what I was looking at, now there's a few candles here that weren't here before, but this was a little bit of a top on the 12-hour. I know the 200's down here, and I know that we're failing. I'm anticipating that eventually I come back to tag this 12-hour. This 12-hour 200. That was my target. So let's just go back to the 30-minute. Let's just go back to the 30-minute with the volume profile. And this kind of rings into what you were talking about, Mike, okay? So It's one thing to have the chart in full view for us, but let's remember that's not what it's like when we're reading it, right? When we're reading it, we're simply looking at one candle at a time, right? We don't have the luxury of seeing everything that's about to unwind at the other end in advance. Is all we can do is increase the probabilities of understanding what that may be. And on this chart, this green line was the upper value range, lower value range, and that's the point of control on the 30-minute. So you know that beneath the point of control and above the point of control, it will be kind of gappy for volume. And why that's relevant is because in areas where you see those gaps, and this kind of speaks to your question, Mike, in areas where you see those gaps, that's a representation that there's very little trading there. That's what it's showing you, right? The candles that created that gap have been filled with fairy dust and air. And when price comes back to retest them, they put up almost no fight at all, typically, right? And that's why I like to know where those gaps are, because ultimately I want the lower value range, right? That was, if we remember what this chart looked like back down here, right? I wanted this gap. Here's the area where the 12-hour is, which is ultimately the target. It made the lower value range. So I was short here. I got stopped out on this candle, but we talk about all the time. So if you get stopped out, let's say you're short, you get stopped out on a candle like this. Let's go back to it. Right? So if you get stopped out on a candle like this, what am I looking for? I'm looking to see what this looks like on the right-hand side of that chart. If that divergence is significant and arcing down or still in place, and notice where this candle failed, it closed at the T line, right? It was way the heck up here, closed at the T line. The divergence is there, the downtrend is still intact. So what did I do? I did the same thing that I told you to do, to tell you guys to do all the time. You re-enter the short, right? That's what it's telling you to do. Re-enter the short, and that's what I did. Right. Exited down here. I didn't trade the long, because I just wasn't around to do that. However, I was around for the other short, which I was able to get in and around up here again. I got stopped out again today, but I re-entered the short twice. This is the same stuff that I tell you guys about twice a week, every day in Telegram. This is what we talk about. It's not a crime to be stopped out of trades, right? Consider it a badge of honor, right? I am not upset that I got stopped out here. I got stopped out with profit. I'm not upset about that. I'm glad I didn't lose money, because that was the other option. I'd rather not that be the case, right? And because I understand how to interpret the chart, I was very confident, like I can tell you all the time, you should be very comfortable to re-enter that short. And where would your stop loss be? Right up in here. As soon as I am a little bit green, I'm going to slip a stop in, because I don't want to lose anything. Right? 9 times out of 10, if you catch these properly, you don't even have to worry about the stop coming back to bite you, because the move down is substantial enough that it's not an issue. But this is the stuff we talk about all the time. As long as you're trading below these levels, stay in the trade. If you don't want to give away anything at the bottom, fine. Take your money off. That's okay. But you have a clear understanding of what price is doing. And here we are, the same 30-minute chart. If this becomes a failed breakout, right, so we have this big move down, none of these candles have been able to change trend. And when I say that, I mean, like, has any of these candles pulled the 5 up through the T line like this? No. Still a downtrend. So this looks like it's a failed breakout where price moves up, kind of tops out, and then starts to arc down. And then what do? You come back and take out the previous wave's low. That's the downside risk. Upside opportunity, you finally break here and start taking out previous waves highs, right? This would obviously be an obvious one. And then this looks like some sort of this would be a structural level on this time frame as well. And then these highs. It's no magic to it, but the most important thing is understanding what the trend of the time frame you are trading is. That is invaluable. Because what happens? People get faked out all the time because of the volatility in price action. And it's understandable, right? Especially for leverage traders, it's very understandable. You don't want to hang around. You don't have time to see what happens next. But for those that aren't using extreme leverage, or a little bit, this is money in the bank. If you know that you're on the right side of the trade all the time, you're in the driver's seat. And if you make a mistake up here and for some reason go long here, right? Like if you go long there, that's on you. But guess what? If people aren't understanding what price on the chart is telling them, you're going to make a mistake, right? And who are those people? Those people, you run into them all the time. Oh, yeah, you know what? If you just watch, if you want to see a stock go down, just wait for me to buy it, right? Because they don't really understand where price is on the chart at the time they bought it. That's all. It's easy to fix, but you have to know it's a problem first. Like, I think it should be a prerequisite to understand how to read price on a chart before you trade financial markets. You know, they make you take lessons to drive a car and a boat. Anyways, people put themselves in a lot of danger when they don't have any understanding of what they're seeing on a chart. Right? And, you know, we've all been there, right? Because we've all been green, as in new, at one point in time. So make sure you use your stops. It's not a crime to get stopped out. Whoops, it's not a crime to get stopped out. It's actually a good thing, a badge of honor. You should be glad that you got stopped out. Right? So here's the same 30-minute chart using the Heikin-Ashi candles that we talked about. And if I throw in the parabolics, it might even make it a little bit easier for you. But I'm just trying to demonstrate that you don't have to have 30 indicators. All you need are a few simple guides and triggers to help steer you through the trade and to have a system that mitigates risk and maximizes profits for entries and exits. And if you can manage that, you'll probably be okay. Right? I think you would be okay if you took this candle, right? I think you'd be okay. I don't think you'd be upset, right? Here's that candle. It's this one here. If you took it here and gave up that, this is your insurance that you paid to be right. That's what you paid to be correct and on the right side of the trade right from the start. And you're going to save yourself a lot of Xanax by making sure that you're on the right side of the trade from the beginning. Because if you're not, it just becomes another chaotic moment in time, right? Where you have to make decisions that you probably wouldn't like to make, right? But again, this would be your entry candle if it was the Heiken Ashi, and this little bit at the bottom you're not worried about because you could ride it all the way up to the top, and you would just be using your T-line and 5 EMA to help guide you. Follow the yellow brick road. Your chart is a treasure map. It is not meant to be front run. Follow it. Okay? The Heiken Ashis, simply for newer traders and for those that like trend identification, do a great job of taking out noise and showing you trend. T-line and 5 are going to do the rest for you. And you can use this stuff. It doesn't matter what you trade. It's all doable. Right? There you go. That's the Dow, 30-minute Dow chart.
That's the Dow.
So if you're trading futures, for example, let's go to an hourly. So like hourly futures charts. So nice, clean moves that are easily identifiable. You have clear indication on safe entries on which candle to enter at. Clear indication to trend, and a clear indication of when you should exit trades. And because you're using multiple time frames, right? So if you're using that 1 hour and it started to look a little chaotic or feel chaotic at a certain point in time within it, switch to a 4 hour. Switch to the 30-minute. Right? The 4 hour, even though it felt a little saggy, look, the 4 hour was telling you that the trend you were in was still intact and gaining speed, right? What we believe price should be doing is irrelevant. Instead of trying to read the chart.
Yeah, to be fair, like when I first started, I did switch to the Heiken-Ashi, and that actually like took a lot of stress out of trading.
Yes.
Because when you're looking at just regular candlesticks,
Yes.
it does, like when you see especially like a drawdown,
Mhm.
it gets you, it just plays with your mind. So I think it was about my 8th month into it, and so my first year like studying. The second year was when I was like, I did like a month of demo trading or so, and then I went into prop firms, and I switched to Heiken-Ashis because I saw this one video, and that took a lot of stress out of trading.
Yeah.
I sort of like, I don't know why I jumped out of like utilizing Heiken-Ashis for
Here's
keeping up with the trend.
here's what it does, Mike. It takes the noise off the chart.
But this lesson today honestly has brought it back to me, and now I remember.
No, well, I'm glad, and I
Ring
think
is like, dude,
the
because a lot of times when I do mess up is because it fully does. It takes the stress level out as well.
taking the noise out of off the chart and smoothing everything is, I think, a trader's edge. When everyone else is trying to wait for an indicator to tell them something, right, or to read something of an indicator, the chart will tell you. Like, the chart really will tell you. And this is dead ass simple. Using a T-line and a 5 EMA as a trigger, that's pretty simple. But like Stephen Bigelow used to say, there's Fibonacci-like properties to the T-line that I can't explain. And I think he was right, or is right. Like, we show in here all the time how to manage your trade using that methodology, using it as, an entry, as an exit, a key for trend, right? And again, it literally works on anything we want to apply it to. So over any time frame, let's use a weekly. Like, this is a weekly, what they call ES, which is the futures contract for the S&P. I think it gives you incredibly clean reads on price, and the T-line and the 5 EMA filters out so this retracement was not the sky is falling, And every time you see this on a chart, right, everybody thinks that, oh, this is the one that tanks the market. This is the one that tanks the market. Eventually there will be one, but we haven't seen it yet. What didn't happen here? The 5 EMA never breached the T line, right? The momentum down didn't continue on this candle to pull it. It got bullish, and then the beat goes on. That's pretty simple stuff. You know, I don't need, and neither do you, I don't need to watch business news to figure out what this means. Really? I don't need an analyst to tell me what this means. I don't need an analyst to tell me what this means. Keep in mind, this is a weekly chart, right? Like, the chart's telling me everything I need to know. I don't care why. Why is the stock market going up? I don't know, don't care. Why did the stock go down? I don't know, don't care. The only thing that matters to me is, can I monetize it? That's it. Other than that, I don't give a rat's ass. They don't care about me either. They're not sitting around the boardroom wondering about what I'm doing. They're sitting around the boardroom trying to figure out what's best for them. I'm sitting in front of my screens determining ways to monetize what they do and don't do. The market will tell you whether or not you're doing a good job. Like, as an executive recruiter, I'll tell people, C-suite clients, if you're a publicly traded company, whether you like it or not, your stock chart's your resume, buddy. Suck it up and get used to it. Because that's a fact. I don't care where you went to school. If you destroyed the previous place you worked at, no one cares where you went to school. The jokes they'll be making won't have anything to do with where you went to school. So yeah, if you're running a publicly traded company, you better damn well believe your stock chart's your resume. Most of them know it. That's why they like to make it go up all the time. But what they do and what the market does and what people say doesn't matter. All you have to do is have a few simple tools to monetize the chart. Whether it's their actions directly or not, doesn't matter. Who cares? I don't care. All I know is that when I see a doji like this at the bottom of a down move, make it more obvious for us. So, downtrend, doji, 5 EMA and T line kick up. There's my Heikin-Ashi entry candle if I was going to take it. That would probably be our confirmation with the cross in and around this candle, and here we go. I don't need anyone to tell me what to do with this. Or, more importantly, what to do when it's like this. Because it's one thing to look back and say, oh, look what I did. But hey, you got to know when that starts. And how do you figure out where price might go in the future? Look where it's been in the past, right? Current price revisits past. So in the event of an uptrend, it's looking for past price to the upside. In the event of a downtrend, it's looking for past price to the downside. So what happens when you break out? What are you looking to do? You're looking to take out what? The previous wave's high. And you do it again, right? You keep looking for the previous wave's high. And so on and so on. Now, these charts to me, like, especially the long-term charts of the indexes, that's what QE money does, in my opinion. But that's okay. Doesn't change how price behaves. Because all it does is it explodes the ranges that we use when price goes parabolic. Which is kind of what happens here. And what does that look like? Well, just let me take the candles off for one moment. And let's flick on everyone. I'm going to take off the parabolics because they get in the way. All right. So what happens when price goes parabolic? You spread out all of your major moving averages like a fan. And this happens on any time frame. This can happen on a 5-minute time frame, a 15-minute, a 4-hour, or in this case, a weekly. When it's like when all your moving averages kind of come together and twist. I'm sure you've seen a chart where you have like the 20 and the 50 and the 200 somehow have all come together. And then when price explodes, they fan out just like this, with the shortest time frames moving the quickest, obviously, right? And then the time of those averages, so 20 and 50, creates the space in between. And when we talk about breaking levels, when we talk about breaking levels, so here's an example where you're trading above all major moving averages, right? And at some point in time, you start to come back and check them, even if it's just for continuations higher. But when you're trading above them, you have to expect at some point in time that you will come back to check them. Do they all lead to massive failures? Of course not. But it's just a level like the 20 as an example. It's where price doesn't like to get too far away from. As you can see, it likes to come back and make contact with it. It's like the horse that doesn't like to be too far away from the barn. But what we know is that when we break one level, we find the next. It doesn't matter what you're trading. It's an index, a stock, a crypto, a commodity, and it doesn't matter the time frame. We've shown this. We show this every week. Where do you break down to? Right to the 50. This is a weekly chart, by the way, and you literally wick the 50. So you broke one level, you found the next. Right. We go sideways. How often do we show this? Impulse down, sideways back to the T-line or 5, and then the trend down continues. We show this every week. This is weekly ES, for crying out loud. Like, you know, broke one level, found the next. Have we found the 200 yet? No. But we will come back and address it at some point in time. Time, in the sense of the average in price, will come together eventually. But as all that's happening here is that in the event of an uptrend, you're looking to take out the previous wave's high. It just so happens that it's an all-time high in this case. And again, you know, happens on every time frame. And I just want to fan this out here because I want to show you that this is why we use the volume profile. I'm just going to take this off for one moment. So, upper value range. This is the point of control. Right? This is the area that's kind of like the equator that grounds the majority of the volume from past. And I think the look back is 200 candles on the screen or something like that. So it's a significant amount of time. And then down here is your lower value range. We don't like to be too far away from the 20. And at some point in time, you're going to come back and tag it. And you know, here you've made new highs. We'll probably chip away at that for the balance of the week, maybe into next. But at some point when you retrace, you always have to be worried about what comes next. And when we do pull back to the 20 and the 50 on the weekly, it'll feel like the sky's falling. Like you'll hear people talking about the end is nigh, right? Like that's how it gets all the time. Again, not always the case, but you know, the potential for any significant pullback gets the attention of traders. Remind yourself that this is very light trading up here. That's why it's gray and not green. This is the most dense trading. And this gap and the 200 MA are aligned. Just saying. So at some point in time, you know, if we pull back, maybe they meet in this gap or at the upper value range. But the upper value range and the point of control, these value ranges and the POC, they're draws for price. They act like magnets. So at some point when they start pulling, we'll know. Any questions, guys? Then I'm going to take these off because... Oh, I know what I want to show you. For those that were trading this morning, okay. Who was watching this? Anyone? I tweeted about this morning because I wanted you guys to see this. So, today was a news day. I know we've talked about this before, trading around news days and what can happen, good, bad, and indifferent. News days usually, not always, there's some sort of volatility that comes into play. This candle on the far right hand side of your screen was your 8:30 15-minute candle. News came out at 8:30. Where did price go? Right to the 50 MA. Now, if you look at my tweet from this morning, just after 8:30, you're going to see a solid red candle sitting right on that 50 MA. And as soon as it hit it, it pulled up. These are the things that I'm talking about regarding setting targets. This was your target on the short side at news. And instinctively, when this thing pulls back, you're going the other way. Like, it's literally that quick. But if you look at the tweet from this morning, you're going to see at just after 8:30, a solid red candle just sitting right on top of the 50. Break one level, you find the next. It is not an accident that that's where it went. This happens time and time and time again. And this is why you want to set targets and use the ranges as targets. Like, this candle hammers the 50, shoots right back up. You know where this candle's going. This candle is looking for the next level. Conservatively, it's the 20. You're hoping for to hit the T line and or the 5 EMA. Right? That's one massive snap back up. But it's a failure candle, right? Where does it go on the reverse? Right back to the 50. Hits the 50, returns to the 20. First attempts typically fail. Where's it going to fail to? Right back to the 50. And then, my next favorite thing in the world is green candles at the 50. Like, there's your confirmation from the T line and the 5 EMA, and price just, look at this is telling you your trend is good. Right? Break one level, first attempts, typically, in this case, it's going to get rebounded up. This is the first attempt at the 20. This is all happening in two candles, which is crazy, but it's what's happening. And then you shoot back, hammer the 50, and in this case, you bounce. Big wicks though, eh? But you bounce off of it, and gotta love that. Green candles at the 50. And now you've gone on and kind of making new highs as well. Yep, so. And the volume gap is going to look the same, right? This is all gappy. If you come back and start to test these levels, you'll probably test the 50 in and around there, if it's the pullback. But right now it's a bullish chart, right? And that's all you can work off of, right? You know, what you think is going to happen next doesn't really matter. You just have to go off of what you see currently and make your best decision from there. We know this divergence still means bullish, right? And it means that until it doesn't. So, for, you know, again, for those that, you know, don't have the luxury of having countless indicators on your chart, don't think that you can't be successful with just a couple, because you'll be just as successful as anyone else. Right? Throw the 5 EMA and the 8 EMA on your chart. Take out some of the noise by flipping on some Heikin-Ashi candles. Add a parabolic SAR, and you've got a very effective, safe, powerful way to trade long and short. Right? This is NASDAQ daily. There's your entry candle short. You're trading on the south side of the T line and the 5 EMA. Sideways stuff we're not interested in. Right? Another short candle confirmation here. Another move down. And then you know, I like this. This didn't last, right? This candle here, this would have been an entry candle. And if you would have entered there, this is why you would have a stop in and around the bottom of that candle in the event of its failure, which it did. But then again, you can re-enter. It's no harm in that, right? You're going to get those moves. But this is a real clean way to trade. So if you don't have a ton of indicators, you don't need them. You just need a couple. 2 AMAs, which I think if you're using the free version, you could put on no problem. You just need a community script to help you with a few other little things. And then you'll have an effective system on them to deploy. And when you're learning, this is a great way to learn. Right? Takes the noise off the charts and gives you the sensation and the feeling of that ebb and flow of the market, the up, the down, the sideways. Anything else, guys, today that you want to talk about, or any charts you want to look at? Yeah.
Is the parabolic SAR, is that straight out the box, or is it customized at all?
No,
okay.
It's straight out of the box. The only thing I change is the colors.
I got you.
I think it starts. I like circles. It's just easier to see. But yeah, that's all it is, right out of the box.
Well,
So you don't.
I found a lot of value with this for sure. Heikin-Ashi's, parabolics, and then just these two, the 5 and the 8 EMA.
Yeah.
It's pretty powerful, pretty simple.
Yeah. Now.
Definitely looking forward to it.
Like you and I were talking a little bit before, if you're to go on your BYDFi chart, just as an example, okay, and I'm showing you one now. If you're to use this chart, the nice thing about your exchange charts is that you can put on as many indicators as you want, right? So, you know, if I want my EMAs, or moving average exponential, there's the 5 and 8, there's 2, and then I'll use, you know, a handful of just simple moving averages, right? And then I'll just go in and set up my chart just like anything else. Maybe I want to add a MACD, right? Whoops. Well, I can do that. Right. Take the volume off here. So there's a MACD. Maybe I want to add I don't know, stochastic RSI. There we go. Boom. Right. And it's just like setting up your TradingView charts. It's no different. They're basically using a TradingView plugin on their exchange chart. So it's the same kind of functionality. Right? You just can use as many indicators as you want. So if you don't have a BYDFi account, grab one. And what you can also do is demo trade somewhere here. Where the heck is it? Here it is. It's under derivatives, and then just go down to demo trading. And you just click on it, and you can set up your charts the same way that you would, except you're not using real money. Like I said, your indicators, set them up the same. And in practice, you don't have to practice with real money, although when you do, it sometimes keeps you a little more responsible. But if you want to demo trade, it's a great way to learn, and you can do it right from within BYDFi. And then just can go back to the regular exchange whenever you want. And since we're in here, for those that like meme coins, because I know there's some, within BYDFi, so up in the left hand corner here, you'll see it says MoonX, and if you click that, it takes you into the meme section, or should. There we go. And you got all kinds of stuff in here to look at. So you don't have to jump from exchange to exchange to look at, memes, for example, if you're into that kind of stuff. So, all right. So yeah, I would really encourage you to try simple Heikin-Ashi methodology, just using parabolic SARs and the 5 and 8. Give it a shot.
Yeah, I think I'm gonna do that. I'm just gonna go back to just simplifying it, because I've realized that,
Less is
like,
more.
last week we were talking about yeah, exactly. Because I was reviewing myself and realized my charts are looking rather messy,
Yep, I understand.
and I think that's one of the reasons why I had to trading week, because I just had lines. I was just overanalyzing it, and I was pretty much which was to just out. So I'm going back to just more.
You're
Because
actually Mr.
this lesson
Ricardo.
was great. I appreciate it, Blonde.
Yeah, no, sorry, you're actually breaking up a little bit, Mike. But I think we did kind of get the gist of the message, that smoothing out the charts, less is more. Take the noise off, and if you have solid entry and exit signals and a good identification of trend, you'll be okay. Right? Mitigate your risk by using proper stop losses, and you'll be fine. So, any other questions today? Charts you want to look at? Eduardo? I see you there.
Well, I want to report I have a silent student in Sarah, and she's doing great.
Excellent.
I'm witnessing the miracle.
So, if your wife turns out to be a better trader than you are, you're gonna have a problem.
I'm retiring.
You're
I'm
gonna
ready to
retire.
retire. So that's why I'm betting all my future on her little finger and beautiful eyes.
Well, you know what? It's really good to hear that that you're actually doing this together. Right? That's fantastic. It really is.
It is, but it's more fantastic to know that there's somebody with your knowledge, time and time again, Blunt. And I guess anybody here in this room is grateful and respectful of your knowledge.
Well, listen, I'm glad it's working out for both of you, and I appreciate that. So,
Just a quick note. I mean, it is still on demo, so it's monopoly money, but it doesn't matter. I mean, she's been having a good record, and eventually she'll get comfortable with real money.
yeah, no, that doesn't sound like it's all that far away.
Yeah.
Well, so there's your weekly NASDAQ chart. The beat goes on. That's all we can say. The beat goes on. Here's our weekly oil chart. Not much has changed. Right, we are still It's a big weekly red candle. So just as this would be any chart, what we're looking at is, will we close below the T line, or will we close at it or above it? You know, closing below it is just a signal that that's a bearish signal, just full stop. So we'll see what it brings. We will see what it brings, and we'll be able to pick that up on Tuesday of next week. If there's, you guys had any other questions before I close down? I gotta head out to another appointment, but if there's anything you want to ask, do
Good,
it now.
man. I'm good.
Okay. All right. Well, hopefully
Thank you, Blunt.
Yeah, you know what? As we were talking before, I think what I'm going to do is, because a lot of traders, especially the newer ones, struggle with the interface of the exchange. You know, the order book and you know the order panel. It can look a little ominous and confusing to some. So what we're going to do in our Telegram group is we'll have a session where we can go over all that functionality. So, and regardless of what exchange you're on, it'll all be the same. But so that you'll feel more comfortable when you're on there. So we'll do that with our own group in Telegram. And if you're not in that group, I encourage you to join because it's free. So, all right, guys.
Thank you, Senor Blunt.
All right. We'll talk to you later. Good to see you.
See you
Good to
around.
hear you, Eduardo, and we'll talk to you soon, guys.